there's still going to be this complication for Americans who are paying tax in the US. Yes, granted, they've got this 4-year fig regime if they're coming in, where they're going to have this reporting or filing issues more quickly than they would have had under the remittance basis, because you've kind of got 4 years to work out whether or not you want to stay in the UK. In context, it's quite a relatively short period of time to get in order.
Welcome to the US-UK Tax Talk podcast. I'm joined today by Josh Moss, Executive Director at W1M. Josh is an expert in US-UK wealth management, and he's come on today to talk about how his world has changed after the UK tax rules got changed on the 6th of April 2025. We hope you enjoy the episode. Josh, hi, good afternoon. How are you? Are you doing all right in what is currently the UK's largest heat wave of the year?
Yes, I'm doing okay, thank you, Aidan. It's a good time to be in an air-conditioned office. How are you, sir?
I am currently sitting in the loft in my house where immediately before this recording, I turned off the air conditioning unit. So what we're going to see is how quickly this room heats up and how well it contains the air conditioning. So eagle-eyed viewers on our YouTube channel can see if they can just spot the sort of little bead of sweat as it goes down my forehead as we try and battle against 30 plus degrees heat. But, fortunately, the topic we're going to discuss is so red hot, it's going to make the temperature pale into significance.
I didn't realize when you initially invited me on for a podcast that there'd be visuals, but it feels good to be live as well, as much as anything else.
I like to keep that bit secret from people until the last possible minute. So we are here today to discuss the tax changes that came out on the 6th of April 2025. And people that have been listening to this series for some time have already heard me discuss it from a tax perspective. But one of the things we haven't discussed yet is the impact on your industry. So Josh, for those that are tuning in, is a wealth manager with W1M and specializes in cross-border US-UK wealth management. And your world, just like mine, Josh, I think was undoubtedly upended a little bit with these tax changes on the 6th of April. So this is as much a pastoral check-in on with you to see how you are and check whether you guys are still doing okay after these rather big tax changes, but also maybe to try and score some tidbits from you about some of the things people should be thinking about and the way that maybe their financial planning has changed in the last couple of months. If that's okay, I'd love to pick your brain.
For sure, more than happy to, Aidan. I think that always working with international people, internationally mobile people, change is inevitable, right? When you're dealing with multiple different tax jurisdictions. So we've got to be able to be flexible enough to go along and adapt to those changes.
And adapt to them, people have to, I think. So a quick recap for those who have not yet had the pleasure or the misfortune of having to think about the tax changes that came out on the 6th of April. We're really talking about two different things in particular, or 2.5 different things. People coming to the UK for the first time now get a 4-year tax-free regime known as the foreign income and gain regime. You'll hear us refer to that as the FIG regime. And that is applicable to people that are arriving in the UK for the first time, or for those that have spent at least 10 tax years living outside the UK. Coupled with that, in kicking people off of what we referred to previously as the remittance basis, we also have what we call a temporary repatriation regime, which lasts for a couple of years, starting from now, where people who were previously on the remittance basis have the option to bring money into the UK at a lower rate of tax than they would have done under the previous remittance basis rules. And then finally, an inheritance tax regime that says that once you've been in the UK for at least 10 of the previous 20 years, your estate is going to be exposed to inheritance tax on a worldwide basis. But prior to that, in your first 10 years, we are limited on inheritance tax to really only your UK assets, or at least that's the default position. Josh, I don't know if you've ever heard those rules explained in a shorter time frame than that, but is there anything else in those rule changes? I appreciate it's going to affect different products, different investments, different ways, but anything else that I've missed off that you think is pertinent for this discussion?
The only thing I would say, I think you summarized it really well. The only thing I would say is that sometimes we can get lost in acronyms, the world of acronyms. So it might be worth maybe from the outset, just in case we do fall into that we go through a couple of the acronyms that are currently existing.
Yes, and you can tell me off over the course of this episode if I slip back into my acronyms. I think there's going to be 2 acronyms that we're going to use most frequently here from the tax perspective, which are the FIG regime and the TRF. So the FIG regime is the foreign income and gain regime relating to that first 4-year period that someone has to elect not to pay UK tax on their foreign source income and gains. And the TRF, which is the temporary repatriation facility, refers to a temporary regime that people that were previously on the remittance basis of taxation can use to bring money into the UK to repatriate it, so to speak, at a lower rate of tax than they might otherwise have done. And that rate of tax is going to be between 12 and 15% rather than the default rates of tax, which could be up to 45%. But you're absolutely right, Josh. If you start talking about PFIX, I will flag you on your use of acronyms as well. Don't worry. So I think where I want to start you, Josh, if I may, is at its kind of broadest scope. How are you dealing with these new tax changes? Before we get into any sort of specifics, what have they caused you to think about? Are there new things you weren't thinking about previously? Are you able to relax or put to bed some things you thought about? How has it kind of worked on its most general level?
Yeah, it's a good question, Aidan. I think if I split it into kind of two main parts, I think that what we've been working on a lot at W1M has been clients that are already in the UK and the transition that they're going through from being what was known as the remittance basis into maybe a long-term residency or the FIG regime if they'd only been here for a while. And that has created a lot of uncertainty. Obviously, the media have picked up on the fact now that that people are leaving because of some of those transitional reliefs and specifically for clients that have been here for longer than the 15 years, and I know we'll go into that. I just hope that by the time this podcast is released, we haven't gone through another U-turn or a change, so it remains relevant. But I'm sure that, one thing we can guarantee is, as I said before, is regulation will change.
Yes. From my perspective, I think one of the things that clients have valued when they've been talking to me, and I wonder whether you see it in your own profession, is that we at least have a sense of clarity. Previously, the remittance basis was a really quite complicated regime. And for clients to try and get their head around what the remittance basis was, and particularly for Americans, because it kind of hit differently, the idea that you could not pay UK tax up front while you were still paying US tax. But if you then brought the money into the UK later, you'd have to pay the UK tax anyway, and you might preclude yourself from claiming a foreign tax credit. That made that for actually quite a complicated tax regime, to say nothing of is someone a UK domiciliary or not, which was a wholly subjective test and a really inefficient way to levy inheritance tax. Do you find that, albeit in the X months or so since the rules were announced and then since came into force, have people at least been warmed up to the idea that clarity is at least a good thing, whether or not they've become worse or better off, at least they know where they stand?
I think so. I think that, we have always been, as professional advisors, working in a bit of a grey area, and what someone's interpretation who's able to give advice is different to another person. So the fact that even if a client, going back to one of those rules where a client or a person who was a non-dom, who wasn't from the UK, was able to be in the UK for 15 out of 20 years before having to discuss inheritance tax on their worldwide assets. The fact they could then leave and not really, it was a very grey area on whether or not they would keep domicility for, what would be 6 years, to split away from that 15 out of 20. But even further than that, to now we go into a regime where it's very black and white. You are a UK resident on a statutory test, and if you've been here for a certain amount of time, you fall into this set of rules. I do think that clarity, at least on that part, has been very, very helpful.
I completely agree. And someone who comes to the UK for the first time, who has been here for a short period of time, knows, well, at 4 years I'm going to suffer X, and at 10 years I'm going to suffer Y. And I'd imagine from your perspective as an advisor, you like working on time horizons where you can say to people, look, this is what it's going to be for X period of time, and we can invest for that basis. And in Y period of time, this is going to transition, or this is going to be your new horizon. And that allows you to give people a longer scope rather than saying, well, I mean, you could claim the remittance basis in this year, but maybe you don't want to, depending on what level of your income is. And also, do you want to even remit the money that you had on the remittance basis? It starts to get quite complicated. Do you find that time horizon being set more in stone makes your job of planning easier?
Yeah, look, I think, as I say, I know I keep going back to this, but, you've got to be adaptable, right? The first part of planning is that that it's never linear. People's lives just aren't linear. So you've always got to build something that is adaptable, and especially where there is international exposure, that it's adaptable to change. So I think from the beginning of when you start doing any sort of plan, that's always has to be at the foundation of what you discuss. But no doubt, I completely agree that when there is a level of certainty in a very uncertain world, then at least certain points of time that you can then plan well ahead of those rule changes.
Let's take one of those times you can plan for, because it's the one that appears the most attractive, and I think probably is the most attractive. on the face of it, it's the giveaway under the new rules, which is this 4-year foreign income and gain or FIG regime. You and I have discussed previously, both together and also I'm sure in our respective practices, that one of the things about people coming to the UK for the first time that is quite difficult is, when do people have to plan? How long before they come here should they be taking steps to make sure that their portfolio is correctly structured, or that their estate planning is up to date? And I'd always used to say to people, no, you need to get your planning completed at least by the end of the tax year prior to your arrival. So if you were coming in September, you'd have to get it done by the 5th of April prior. Of course, with our new regime, if you so choose, you can designate your foreign source income and gains as not suffering UK tax at all, subject to the requirement to disclose what you're doing to the revenue. It's not a no disclosure regime, but it is a no tax regime. Does that affect how you would be advising people in thinking of coming to the UK for the first time? Because suddenly you're not met with this kind of cliff edge where you have to be completing the planning before you come here. You at least have 4 years before really tax is going to start to bite.
It's a really good point, Aidan. I think that, whereas we'd have loved to have been in the conversation ahead of someone's move to the UK, I think that there is a longer timescale to get assets reorganised. From an investment standpoint, the reason that we like to have a sort of pre-arrival plan is that, it was complicated when people moved to the UK. So you had to structure affairs outside of the UK in an effective manner and understand how you would access them, and also make sure that the investments that you were investing in were tax compliant from the UK, so that you didn't create any issues down the line, or you could do it up front. I think the world we've moved into this FIG regime means that we have a longer timescale to get someone in order, so we don't have to speak to them when they're on the ground in the US, for instance. We can speak to them when they're in the UK. But I also would probably just say from a practical standpoint that sometimes it's not just the investment or the tax part that matters. The majority of US institutions, unfortunately, does still to this day doesn't really understand why people leave the US. So from a practical standpoint, we need to be aware that if an address change was to happen, and we've seen it at somebody's institution or bank, they don't just get a tick in the post of everything being sold on the day that they've left. We've got to make sure that there are institutions out there, and will deal with non-resident Americans.
Of which there are not many, and why someone will want to visit, say, WNM, for example. Let's take of a real-world scenario. So I'm going to use my Mickey Mouse understanding of the way that US investments work to pose to you what I'm sure is a very simple explanation. So one of the most classic investment products that someone in the US with a normal, quote-unquote, portfolio might try and invest in would be a US mutual fund, a really common collective investment in the US, which I'm sure you will say, Josh, always has been the case, likely not a clever investment for UK tax reasons. Under the old rules, someone had, in practice, a deadline of the tax year before they arrived to think about maybe selling off some of their mutual funds before they came to the UK. Because if they did it while they were UK tax resident, there would be some disadvantageous UK tax consequences. Whether you'd like to refer to those or not is up to you. But now they have this 4-year regime, which I'm right in saying means, look, if you want to purge your portfolio of your mutual funds or any of those other disadvantageous products, you've now got 4 years to do that without incurring the higher burden of UK tax that would arise if you were to otherwise do it when you became UK tax resident.
Yeah, correct. That would be my understanding of the rules as they are today. I think that that you do have that extra time. There are, and the main thing, Aidan, is the accessibility, right? One of the things that we were really conscious of when people were arriving before having any sort of pre-arrival planning. And by the way, 99, I'm sure Aidan, 99 out of 100 people that came to the UK hadn't done any pre-arrival planning. So Correct. We're always operating in an environment. So this is just quite helpful in that we can do it in a more time efficient manner. It's more accessibility. I think people won't have to make decisions that are just purely based on punitive tax rates. But actually over time, especially if they're looking to stay in the UK in the medium to longer term, they can make sensible planning decisions. And quite frankly as well, with the currency where it's gone as well, that's over the last, and we're talking obviously June 2025, that has been a good time as well, potentially to look at, if you were going to bring assets in.
By the same token, that kind of 4-year regime is presumably also quite helpful to you when you're thinking about how clients are going to fund their time in the UK. So, let's say they come to the UK and some of the things they're first thinking about doing are maybe buying a house. It's where their kids are going to go to school, or if they're not buying a house, it's where they're going to rent. There can often be some quite high upfront costs that you need to shoulder when you first come to the UK. And maybe you're going to exit some investments. Maybe you're going to, draw down on some pensions, or you're going to do something to generate the capital needed to kind of see you out through the first couple of years before you get yourselves established. Presumably also from your kind of planning perspective, that 4-year regime is also buying you a window to say, look, we don't have to make decisions immediately to, liquidate all of your investments. We can kind of pick the timing of the release of those investments or the sale of those investments to best suit your returns. Maybe the stock market isn't at a great time, or the exchange rate isn't at a perfect time, and you can kind of pick your time during that 4 years to execute the plan to your maximum advantage. Is that a fair reflection?
For sure. I think that's definitely a fair assumption. And, it feels weird to be sort of working in this world of, multiple jurisdictional, multiple taxes, multiple currencies, where we actually have time on our side. As professional advisors, I think it's something that so yeah, for sure, it's definitely something that we will take into account when we're putting together that kind of plan and making sure, because the old rules were that it was very difficult in some cases to pay for services in the UK because you had to remit money into the UK, and that could have a tax charge in itself. So the fact that we're in an environment where you don't have to consider those types of payments in the UK is a better place to be.
I've certainly said to clients, and I may have even said on this podcast before, it seems like a very good regime, this 4-year FIG regime. But of course, for an American, given that you're paying US tax anyway, and US capital gains tax rates, for example, long-term capital gains tax rates and UK capital gains tax rates are really not that dissimilar. For a lot of classes of income and gains, the FIG regime is perhaps less impactful for an American than it otherwise would be. And that is sort of the good answer to the plan. But what I put to you, and maybe you have more lived experience of this, is there are certain categories of particularly income where there's a really big disparity between the US and the UK rates, like, for example, on qualified dividends, where Americans can be taking dividends with a tax rate in the federal rate of tax in the US at like 20%. But in the UK, we're going to charge them almost double that at the highest rate. And so claiming the FIG regime is still something I think Americans should think about. And when they're discussing their planning with you and realizing funds, the ability to, get rid of, a tax liability at, what would otherwise be a really high rate is presumably quite impactful. They've just got to go through the exercise of actually reporting it to HMRC.
Famous last words these are, but I don't rarely meet an American that has moved, or ever met an American that has moved to the UK for tax reasons, to be in a lower tax environment, right? Americans obviously know that they have to pay tax or at least report tax on a worldwide basis. And the UK is a higher tax jurisdiction. So in the most cases, someone that lives in the UK for a long time will have taxable pay in the UK. You can confirm that's not my area, but
yeah, I'm going to agree with you.
The reason that most Americans I find move to the UK is cultural ties. It's perceived to be a safer environment for kids and schooling and some of the laws that we have in place, the language, the reputation in some ways, which has returned, I think, over the last year or so, whatever anyone's political opinion is, that we have a bit more predictability, stability, means that there is more of an attraction for Americans to come in. So that means that, when we're having these discussions, different regimes, most Americans aren't aware of the FIG regime that when they're coming in or any of the changes, but there is a benefit and, any marginal benefit that you can have as an American who pays worldwide tax, then they should take it. So the FIG regime represents a benefit. Obviously, we're going to get onto this, but there are some downsides, right? One being that, you've got to report your worldwide assets, which you didn't have to do before. You've got to report it in sterling. There is most likely going to be a cost towards that. I know we haven't had the first year of reporting, so we're not aware, but there are some things that are going to make that a little bit more complicated and make the UK a little bit more aware of what your worldwide assets are.
Mm-hmm. Mm-hmm. Yeah, no, absolutely. I do compare the old remittance basis to the new FIG regime, where both can result in no UK tax being paid, but under the remittance basis, the reporting requirements were largely sort of high level. You had to sort of roughly explain what sort of total foreign income and gains you had. But under the new FIG regime, the UK is expecting to have absolute full transparency, full disclosure on exactly all the items of income and gain you have overseas are. We understand, you're right, we haven't had the tax return yet, and neither of us are accountants, and so we won't supposed to do their job for them. But, it'll be interesting to see, presumably, the tax reporting is going to require the exact same level of depth that you would have if you were just going to end up paying tax on it. It's just that the last line on the tax return will say, but are you actually going to pay tax? And you'll go, no, I'm not going to. So you'll kind of have to tell the revenue in this country about your foreign income and gains, whether you're paying the tax on it or not. And that may detract some people, but at the same time, exactly as you say, they're going to be paying that tax and telling the IRS anyway. And HMRC and the IRS are two relatively, at least at time of recording, friendly tax authorities that will share information between them. So you can be fairly certain if someone's in the UK and are reporting some degree of income and gains to HMRC, but they're reporting everything to the IRS and HMRC, should they choose to do so, can quite easily go to each other and say, well, look, what information have you got on this person? And they'll share that information. So I don't know how much in practice the remittance basis was useful at the back end in terms of not telling HMRC. I guess the only advantage it had was it might have made your UK tax compliance slightly cheaper because you had to tell your tax preparer slightly less.
I'm always surprised, Aidan, whenever you meet Americans, how they always remember their social security number. And when you think about it, it's because, from a young age, Americans are always filing a return. So just having to get information on your worldwide assets, it's just the concept of having the UK know your worldwide assets. There's nothing wrong with that. There'll be a cost for a tax reporting person to report on that, I imagine. But it's just that concept of moving to a new country and then wanting to know every information about you, which is probably accessible to them anyway under a lot of the regulations we've been through. But just a sort of a mindset shift on what it was before, I think.
Are you saying you don't know your national insurance number off the top of your head?
No.
I know it's got some characters and some numbers in. There's a number at the end, but I can't believe you on that. I've got to look at my phone every time. So one of the things that you teed up at the beginning, which I think is definitely a part of your industry in particular, is those clients who you previously had that were on the remittance basis. So as a reminder, the remittance basis allowed people who had high enough levels of income and gain to shield those income and gains from UK taxation unless or until they decided to bring them into the UK or to remit them to the UK. And depending on how long you'd lived in the UK, there was sometimes a flat rate you had to pay as a tax charge for the privilege of accessing the remittance basis. So it became more punitive, and thus you had to justify it slightly harder to use it. But it meant that for some of your clients, Josh, you could be more relaxed about what they held in overseas accounts for potentially up to 15 years because you knew that those accounts were going to be, one, free from the scope of inheritance tax, but two, if they didn't want to bring the money into the UK, I'm presuming you would be relatively comfortable they could have any number of horrendously complicated UK investment and reporting products like mutual funds, for example. What are you seeing now in terms of those clients that were on the remittance basis and but for the TRF, the temporary repatriation facility, have been kicked off of it and are now maybe past their first 4 years and are just paying tax on a rising basis? There's got to be quite an exercise to kind of bring clients down from that kind of quite considerably beneficial regime and into, you're just going to have to tell everyone in the UK what you've got as well.
These are more challenging conversations because, when you've been in the UK for as long as, about the 4 years, it becomes your home, right? And all of a sudden to be told that, all of this planning that you had in the past, no longer matters because now we're going to tax you on a rising basis. And in a relatively short period of time, October was the date that it was announced, April being the first time or the last time you could claim the remittance basis. So it has been challenging. And, we've been through an exercise with clients and people that needed some help at the time to analyze the situation. Like accountants are always very, very busy and it's very difficult to be proactive and still quite a grey area of what it was in that October period. There's been a couple of things that we've noticed. One, you could leave, right? And I know that the media's, been very, very quick to tell everyone that everyone's leaving. I don't think it's quite the same for an American family personally, but we've seen that. The second thing is that you've got to reorganize your assets because now HMRC will have a view on if they are compliant or effective or not. And two, you've got to understand that you can't access that money, which is pretty similar to the case beforehand for while you're in the UK, right? So those three decisions, and there'll be a cost, and the cost of that will be the tax you pay in order to reorganize. But I go back to it as I sit here on the 30th of June 2025, or maybe I should say June 2025. The currency has played well for someone in UK terms this current year.
It is interesting to note that if you're absolutely right, that for an American audience in the UK, the inevitable case is always the fact that you have to look at two different regimes at the same time. So it's all well and good the UK changing its rules, but the US has, shall we say, been slightly more tumultuous in terms of interest rates, the exchange rate, and the stock market, that have meant that you're not planning post 6th April in a vacuum when you're an American, because your success and your prosperity is closely tied to the goings on in the US on a political and economic basis. So you're absolutely right that coming down off of this ledge has meant keeping an eye on the US whilst also doing it from the UK.
Yeah, the other thing I'd just add, Aidan, I think is report by one is that, unlike other non-DOMs or non-DOMs that have been on the remittance base and therefore not paid any tax or most likely no tax on their worldwide assets, Americans have been paying tax on these assets for the last, up to 15 years. So that's a difficult conversation when the UK doesn't recognise that they've been paying tax because they've been filing under remittance bases. So it becomes a new tax charge on what's already been taxed money.
Correct. Yes, that is one of the absolute age-old stalwarts of US-UK tax planning, is the fact that tax planning between the two countries is less about tax avoidance and more about tax harmonization. So you want to make sure you're paying your tax in both countries where possible at the same time, because then you're more likely to get a foreign tax credit. I imagine that at least one of the advantages for your clients at the moment, and those clients for whom the last year of tax reporting on the remittance basis is still active, because the deadline for filing that 24-25 tax return has not yet come up. It won't come up until January. Is at least with this temporary repatriation facility, this TRF, people who were previously on the remittance basis have 3 years within which the UK says to them, look, you may have this big old pot of foreign income and gains that you didn't bring into the UK previously, because to do so would have been to incur potentially UK income tax, for example, at up to 45%. But hey, if you want to think about bringing that into the UK now, let's say in the current tax is 25, 26, we're going to only tax you 12%. We're going to tax you basically 1/3, less than 1/3 of the rate that it would have been had you done it previously. So are you seeing clients say, actually, I'll tell you what, not that I particularly want this money in the UK, but I might want the money in the UK, and I'm not going to do better than an additional 12%, even if I don't get it credited against my US tax exposure? Are you having clients come to you to say, well, look, maybe we do have some money overseas that I wasn't thinking of bringing to the UK, but now I'm going to, and let's liquidate while the going is good, or as good as it's going to be?
Yeah, for sure. I think this is an opportunity that doesn't come around a lot, where all of a sudden, as I say, it's difficult for an American because they've been paying tax as they should on a rising basis on these. But it doesn't come up often where you get a chance to access this amount of money outside of the UK in the UK, and to pay a discounted tax rate on that is an opportunity that you need to look at and you need to get some proper advice on, because it could end up being a fairly small or relatively small charge to be able to access a lot larger pot of money that on the day these TRF transitional reliefs end won't be there anymore.
I have a client, I've had several clients in fact. I've got one client in particular who we've known for years had an overseas, US overseas brokerage account that she'd paid the remittance basis in relation to for the first 10 years that she lived in the UK, and wasn't really aware of the consequences of claiming the remittance basis. This is a 10 as old as time, and was just merrily paying tax in the US as she went along, and was never paying any UK tax. And then when it came to sort of year 10 or so, she was thinking, well, I'd really like to bring some of that money into the UK, because I was thinking of buying a home in the UK. And her tax advisors at the time, I must stress, we weren't involved at this point, had said to her, well, the problem you've now got is that you can't bring the money into the UK without bringing to bear all of those UK tax charges that you've deferred at that point. Oh, and by the way, you're not going to get a credit for all the US tax paid. And she's basically had to sort of resign herself to saying, I just can't bring the money into the UK. I've got a pit, a black hole in the US of this money that, sure, I can spend overseas in the US, but my life is in the UK. I'm married, I've got kids here. I really want to spend that money in the UK. And so she sat for about 5 to 10 years knowing she had the best part of, in this case, it was about $1 million, just unable to access. Otherwise, she'd have to pay the revenue, the best part of 450 grand to bring it in. The moment that the UK government announced this temporary repatriation facility and then it came into law, I was on the emails to her to say, I need to be honest with you, you're probably not going to do better than this 12% rate of tax. I know it's going to smart to pay 12% to bring the money into the UK, but the alternative is to pay 45%. So try not to think about it, if I can be so trite. Try not to think about it as a 12% additional tax paid, but try to think about it as 45% less 12%. That difference is the tax you're saving by taking advantage of this opportunity now. And there are probably Americans up and down the country who have this issue, but probably don't realize yet that they've got this narrow window of only a couple of years in which to do this planning. I imagine that's sort of coming up quite frequently.
Yeah, for sure. It's a frequent conversation because, as you say, it's this one-off opportunity to actually, what we would define as, and I say this in investment language, clean your assets, right? Which means that you are able to use them in the UK. The issue you're going to have, Aidan, and this is where I think our role as the kind of wealth managers gets more complicated, is that even under these TRF provisions, you don't have to bring the money in onshore, so that's good.
Mm-hmm.
Right? You don't actually physically have to sell everything and bring it onshore.
Correct.
You have to designate a certain amount of money that you put on your return to say this is how much, and you pay on a self-assessment and you pay this amount of tax. Now, anything you don't designate still falls under the old regime of not being able to bring it in without a significant tax charge. And my concern is when you're now on the arising basis of tax, that means going forwards, you're going to be paying tax on everything worldwide, no matter where it is. It's all well and good having the TRF, which, as we say, I think is going to be a really good use for someone to take advantage of, especially to be able to access money in the UK. But with the assets that you're not going to do, or if you decide not to do the TRF, you're still going to have this level of structuring, which allows you to segregate your gains and income that you then pay the tax in the UK and are able to access it. So it becomes a little bit more complicated than in the previous rules for clients that are already, or Americans that are now here.
I'm really glad that you acknowledge that, because this is one of those scenarios where we go, you've got to really make sure that you've got your brokers, your custodians, your advisors, whoever's the person who's helping you manage your money understands this, because you're right. The segregation of your accounts into kind of pre and post 6th April income and gains is going to be really important. And then the decision as to which of that money to bring in first, whether you can bring the old money under the TRF, but once the TRF disappears, you then can't bring the old money in. But the remittance rules would say that you bring the last money in first anyway on a last in, first out basis. It gets really quite complicated. So for those people who are coming to the UK fresh for the first time, this is entirely irrelevant, and you can just completely disregard everything that Josh and I are talking about. But for those people that were potentially in the UK for up to 15 years and had paid the remittance basis for some or all of that, making sure that your custodians understand the concept of segregation and know how to segregate on a UK tax basis is going to be really important. It was important previously if you were on the remittance basis because you needed to understand how to segregate your clean capital, exactly as you say. It's still going to be important, even though the government has now scrapped the remittance basis. And I could well foresee our dear old tax advisor accountancy colleagues that you and I know well pulling their hair out in the years to come because people just think they don't have to segregate anymore.
No, I completely agree. And it's, and then, there's the fine old age of having to report on it, right? The UK has operated a different tax year in April to April fiscal year and in sterling, especially the American clients that we work with, they're used to calendar year in dollar terms. And as you mentioned, the cost way of actually looking at cost data is different in the US and in the UK. So, there's still going to be this complication for Americans who are paying tax in the US. Yes, granted, they've got this 4-year fig regime if they're coming in, where they're going to have this reporting or filing issues more quickly than they would have had under the remittance basis, because you've kind of got 4 years to work out whether or not you want to stay in the UK, which might be aligned with a certain political presence in the US, and you may then want to return back to the US. And then you're back into really acting like a Brit, right? And for the purposes of your worldwide assets. So it's in context, it's quite a relatively short period of time to get in order.
The way I've described it to people is we've sort of taken that 15-year period, we've kind of squashed it down and concentrated it into 4 years. The 4-year regime is better for you than the 15 regime, but the 15-year regime lasted longer. So we've just kind of concentrated it down and we've turned it into a sort of a concentrate. You mentioned, by the way, Brits. The other thing that is worth bearing in mind, and I wonder whether this is something that you also see, is when we talk about Americans coming to the UK, we're sometimes talking about Brits returning to the UK, either because they're returning with a US family or they themselves are the returning person. It used to be the case under the old regime that person had no help. They would be back inside UK tax within 1 tax year, within 2 tax years for all tax purposes in the UK. And so planning for those people on the return, there was really not a lot that you could do. Whereas now, these kind of returning British people have the same opportunity to do this kind of pre-arrival planning or the post-arrival planning within the 4-year FIG regime as everyone else. It is good news for people that are British and returning, particularly those people that have also returned in the last 4 years, because it might be that they have some of their 4-year period left. But I wonder, are you looking at someone's profile and saying, you're a returning person? Do you look at that with not quite so much dismay as you did previously?
Yeah, I mean, I think with the new rules, the domicile of origin is not as relevant in today as it was. So, if I was to go and live in the US for 20 years, I can come back now and I'm basically seen on the same level as what was a non-dom, which it is fair in some ways because I've made the US my temporary home for a number of years. But what it has meant is, yes, that means that all of a sudden non-Americans or Brits that are returning home now have access to quite a good regime, right? Where if the plan has always been to come back to the UK, this is a good outcome for them.
Yeah. I let you in on a small point of pride I used to have in the Grant family household, which no one else really cared about, but that I was never able to be a formally domiciled resident because I wasn't born in the UK. I was born in Chicago, but both my brothers were born in the UK and so would have been treated as formally domiciled residents. So I used to sort of have a very, very niche technical chuckle to myself. But we all moved abroad and came back again. I could be a non-dom in theory on return, whereas my brothers couldn't. No one else in the family cared about it, but it was a small piece of differentiation that I held close to my heart.
You could spend a long time talking about some of the treaty discussions that seems to take place between the US and the UK, but I'm sure that could be left in another podcast.
Don't tempt me. What I would like to discuss, though, in the time we have remaining, is the one tax that we probably haven't talked about at all yet, which is inheritance tax, which is, I think, on a day-to-day basis, probably less what you see, but it nevertheless has wider underlying ramifications for the way that you're advising your clients. Because people used to have 15 years, and now they've got 10 years before which their assets are getting exposed on a worldwide basis. But we also have the introduction of more assets, kind of quote unquote, inside the scope of inheritance tax, with things like business property relief being curtailed, with pensions falling back inside the scope of inheritance tax. Presumably on a fundamental level, from an inheritance tax planning perspective, your job hasn't probably changed that much since the 6th of April, other than the fact that you now have 5 fewer years before you've got to start telling people where they locate their wealth is going to affect their inheritance tax exposure.
Yeah, exactly. And I would go further than that in that obviously there were clients that we work with who all of a sudden became a long-term UK tax resident without any kind of being told ahead of any change. So those are the type of clients which again go back to the media that people have left, and that has happened, right? We've been through many changes on the non-doms environment. I think when it comes to inheritance tax, that has been a very, very sensitive topic for obvious reasons, and people have had to leave in order to mitigate those. Whilst majority of families that are from the US are understanding of estate tax, we're talking in the context of the US having, what is currently around a $15 million exempt amount per individual compared to what the UK has as a £325,000 nil rate ban. Now, there are some nuances to that in that, the UK you can gift and it falls out of your estate. You can't do that in the US, but that's the context that we're talking about here. So when you've done planning in a US way of making sure that you are able to give assets to the next generation in your home country and use up to that 15 million, to all of a sudden being in what would be defined as a temporary home, 10 years, and saying that now all of a sudden all of these assets fall into the scope of the UK tax HMRC, and you're going to pay 40% on everything. That's a difficult conversation, and it's a difficult platform to prepare for.
And that's why, to the point you emailed previously for, that's why lawyers like me have started thumbing our copy of the double tax treaties that we have with the US a lot more closely, because suddenly there are a lot more provisions in there that we want to rely on. But I realized I was actually being far too generalistic in saying the only real difference is that you're moving from a 15-year period to a 10-year period, because the absolute biggest difference from an inheritance tax perspective for your clients who have trusts is previously you could have had a client who had been advised by their lawyer to create an excluded property trust before they became a deemed domiciliary, which meant that if they set the trust up and put non-UK assets into it before they hit year 15, that trust could be permanently outside the scope of inheritance tax. And so you could run that portfolio that's in that trust on a really, really IHT efficient basis, because all you had to do, all he says in quotation marks, is make sure that those assets were not custodied in the UK or were not UK status for inheritance tax purposes. Whereas now, yes, there is a temporary transitional provision about old trusts set up previously, but if you have a grantor, a settlor who is a UK resident and has been in the UK for more than 10 years, this trust is going to pay inheritance tax to some degree. So are you having to then break this bad news like I am to clients going, you know, that really, really nice trust that some lovely lawyer recommended to you 10, 15 years ago, probably also got paid a fair amount to recommend it to you. That trust is no longer anywhere near as tax efficient, I mean, let alone on an income tax and capital gains tax perspective, but on an inheritance tax perspective as well. And how does that change the discussion you're having about how you manage that trust portfolio?
Yeah, it's a great question, Aidan. I'm happy that I'm not in the game of advising on trust, because you know, as you all know, that you know, when you're talking about an international person and trying to fit it in with different rules and regulation, even though we're in the same language, is very, very different context in terms of what terms actually mean. I go back to the reason why trusts were initially set up, and I think for an excluded property trust, which is you're referring to, its job was essentially to keep the assets outside of the UK when someone became deemed domicile, being that they've been in the UK 15 out of 20 years in the main, right? So there's arguments for and against in terms of, you know, is 15 years long enough to sort of say that the UK does have access to your, but the main thing is that they didn't think that those assets would be touchable, right? So they had to suddenly bring them in to the UK inheritance tax net is a very, very challenging discussion to have someone's planned for that. But it goes back to kind of, you know, if you are looking to stay in the UK in the longer term, then there should be a question about, you know, that your assets do fall into, unfortunately, the UK inheritance tax net. So it's difficult. And it's all about sort of access and, you know, being able to access the money or just gifting it to the next generation, right? Because there are ability to do that.
I'm going to try the words you used exactly there. I'm going to throw it back to a different frame of reference.
I'll try to avoid the answer there.
No, it's fine. You masterfully sidestepping the question. Let me put you on the spot with the questions you may want to answer then.
Please.
Putting money aside in the expectation that it was never going to suffer inheritance tax, and then suddenly finding that that is now exposed to inheritance tax, I want to talk to you about pensions briefly. Because, of course, not now, but announced as part of the same rules was the explanation or the announcement that from the 6th of April 2027, pensions will no longer be a sort of exempt a product for inheritance tax purposes. Individuals will now suffer inheritance tax on their pension assets for what it's worth, in the same way that Americans have been paying estate tax for quite some time. It's just that, as you said, with our allowances being so much lower, the impact is that much greater. Have you now started to see a swath of clients saying, well, hang on, I was told for years, if I save handsomely into my pension, this is not just a long-term way of benefiting me, but a way to benefit my children. What does this do in terms of affecting the order in which I draw down on assets? Because this pension is no longer the kind of long-term, multi-generational repository of family wealth that it once was. How are you tackling that hurdle?
Yeah, and look, as a wealth manager, it is very difficult, right? Because we are trying to advise in a world where this policy is not in law.
Yeah.
So therefore, we are trying, you know, and everyone will have a very different situation. There'll be a different need for access of funds, and there'll be a different reason why you have pensions. For the type of clients that I work with, the UK pension has been a really effective way of passing wealth down the generations. And it has been managed in that way. It's kind of, if you think of a waterfall effect, that would be the last place that you would want to touch because it has a UK inheritance tax. That wasn't what, and I might be controversial saying this, right? But I do understand that the government's point that wasn't what pensions were designed for, right? They were designed to grow tax free, and then you draw on them, especially in a flexible world,
to support your own lifestyle, not to leave an inheritance to your children. I completely, on a political level, I totally see why they did it, but on a wealth management level, it must really be annoying.
No, it is, because it means all of a sudden, and as I say, because we're still operating in this void of not really knowing which way the rules are going to go.
Will they walk them down? Will they walk them back, etc.?
Exactly. We're kind of, it's created anxiety for clients who, in the main, most people will have some of their largest assets being within their UK pension. These aren't necessarily small assets that we're talking about here. So, and there's not much planning you can do apart from take the money out and then potentially gift it away.
Maybe,
right?
yeah.
And in doing that, where we are today to April 2027, you do lose some significant death benefits if anything was to happen to you in that period of time. So it is difficult. I won't sidestep, but, I would say that in the main, I would always advise to have a plan, but you've got to make judgments based on what the law is at the time of deciding.
The personal high horse from which I like to grumble, and I have mentioned this to other people previously, is, it also used to be the case that in the American context, that with pensions falling outside the scope of inheritance tax, a really key part of any sort of estate planning review was to look at the US pension and say, can we get the US pensions outside the scope of inheritance tax as well? Because we might be able to have the US pensions treated like a UK pension if they can be classified as QNUPs, as qualifying non-UK pension schemes, and then they'd have the same inheritance tax treatment. But if inheritance tax is going to apply to UK pensions, then inheritance tax is also going to apply to US pensions. And so the government has also put a nail in the coffin of me advising clients on whether their IRAs and their 401ks are exposed to inheritance tax or not. But I imagine that not many people will cry softly into their pillows at night on the fact that I've lost a piece of advice that I like to give.
No, what I would say, and I do sit on the side with families and clients on this part, is that that rule, without going too much detail, there's obviously when you get to the age 75, it's quite a crucial point in the death benefits of a pension, in that before age 75, your pension assets are tax-free to your beneficiaries. But after the age of 75, it falls into to an income tax charge of any of the when you distribute it out as a beneficiary. Now, this kind of double tax charge after 75 of saying 40% on the pension and then an income tax charge on the way out, to me is kind of the worst of both situations. And I think that there should, the UK government definitely has to relook at that, because I think that would be incredibly harsh policy.
Classic double taxation. I do wonder, as we sit here in summer 2025, quite a ways off from any UK general election in theory, I wonder whether the UK government thinks it can ride out any kind of initial disquiet, because the wave of popularity that the Labour Party was carried into office on was borne out in part by a lot of sort of middle-class families voting for them rather than voting Conservative. And those middle-class families have kind of two large asset classes, their homes and their pensions, especially if they're working professionals. And so by introducing potentially, a person with a pension of some, hundreds of thousands, £1 million worth of pension, to say, oh, by the way, we're now going to make you suffer an additional several hundreds of thousands of tax at your deaths, that's not the sort of thing that's going to keep you enamored with your new wide but quite shallow electoral base. So I do wonder, as we get towards the rumblings of the next election, whether someone, be it the current government or a future government, might look at that as saying, that's quite a big and easy target to hit, to say, well, we're going to take you back to the old regime. Now, neither you or I are political commentators, and no one should be taking what we say as any kind of authority on the topic, but it would seem to me, as you rightly point out, there are some quite large holes that someone needs to plug before these rules come into effect, and certainly, I imagine, before anyone gets re-elected into power. Look, I think that is probably about as much as 30-degree heat can probably suffer. Like I said, I think that we outdid the heat with our red-hot talk of investment management and US-UK tax law. Josh, it's been a real pleasure to have you on today. You and I have talked for a long time about you coming on, and you finally acquiesced to being a guest on this show, so I'm very grateful to you. What I can't let you leave without doing is saying, if people want to get in touch with you, Josh, where and how can people get in touch with you?
Thanks, Aidan. I'm sure on this, hopefully there'll be a link to my profile online on the show notes, wherever someone gets their podcast from. Otherwise, you'll find me on W1M's website, and my email is joshua.moss@w1m.com. I'm always happy to talk to Americans about the good and bad of moving to the UK and how you can set up effectively.
Wonderful. Thank you so much, Josh.
Thanks, Aidan.
Thanks for joining us today on the US-UK Tax Talk podcast, and thanks again to Josh Moss for being such a wonderful guest. A reminder, we're now releasing our episodes on a monthly schedule. Each episode releases on the first Wednesday of every month. Make sure you like and subscribe so that you don't miss an episode. Also, make sure to check out our YouTube channel, where you can find each episode recorded in video. We'll see you next time.